So thank you to everyone for joining. I appreciate you joining the panel. Today, we're going to talk about risk, which is, I don't know, a huge topic when it comes to, well, life, I suppose. There's everyday risks we take as people. There's risks we take as investors. It's a massive topic. So I don't know, we'll kind of bisect this one in various ways. But I guess, from my perspective as an investor, I feel like we're seeing more and more risks. I feel like they're coming at us faster and faster than they used to. I think about my experience in the markets anyway, and not long after I left uni, there was the GFC, and then there was major political change, there was the pandemic, there's climate threats. It just seems like just one thing after another, these risks are accelerating. So I used to tell people that, in the 10-year bull market we were in, the biggest risk was not being invested at all. And now it's, well, geez, I don't know. You should really think about reallocating things, cash, fixed interest, and what have you. So I think it's a very interesting time to be talking about risk because things have changed, certainly. So why don't we just go down the panel and just, Prashant's done the introductions already. So maybe just, just touch on your background when it comes to risk at all in terms of how you think about risk. Rachel, if we could start with you.
Okay, so Rachel Waterhouse, the ASA is Australian Shareholders Association, and I have a background in governance that you've probably heard of, and risk is often spoken about in governance and how you manage companies. So I think the challenge is that often with risk, we're looking at what can go wrong, and obviously market risk is there. You could lose a portfolio or an asset class or a share, but there is also reward as well. So really thinking about your risk tolerances and what they are and what the rewards are is also really important. So yeah, that's how we would think about risk. And being shares, investors really need to think about that asset allocation. And although we advocate for shareholders, you really need to be invested in many different things.
Yeah. Mark, how about you? Background in risk. We know you hold a CFA, of course.
Yeah,
you could speak ad nauseum about all the measurements, the Greeks of risk, right?
Yeah, I think it's evolved over time, and honestly, it's evolved a lot to sort of Morningstar's view of the world. That I will say that, when I was in grad school, when I was studying for the CFA, yes, I was very interested in beta and standard deviation and all these different risk measures. And I think as I got a little bit older, I just started to think a lot of these don't matter to me. And I still, despite all the jokes about my age, I still have a while to go before retirement. And so I think I've become very comfortable with volatility. And I realize it doesn't really matter. It doesn't matter how much money is in my super 2 weeks from now. It doesn't matter how much is in 2 years from now. What really matters is actually when I hit retirement. And I think that there's so many, and kind of, I guess, where my interests have gone to is there's so many behavioral issues that are holding investors back. And so I've just been trying to come up with ways over my kind of investing life to ignore things. And it's harder at some times. It was obviously harder when the markets were dropping after COVID. It was harder, you mentioned the GFC. I'm apparently older than you because I was in uni during the dot-com bubble bursting. That was hard. And that I've just been really trying to come up with ways to figure out, okay, what are ways that I can ignore this and focus on what's important to me? And that's really what I need to achieve goals. So yeah, I'd say it's evolved, and I think it's evolved to a good place.
Yeah. Well, I'm glad that I know that you're older than me. That was my entire goal, to figure out how old you were in this panel.
Yeah, well, it's a secret.
But we do see the kind of ignoring factor at work at Sharesight. We see when markets are not doing well, our engagement really starts to drop off. So it's a bit of that is quite interesting. So anyway.
Which isn't a bad thing, right?
Not
because at the end of the day, it's the people that are checking their portfolio every 5 minutes while
Sure.
the market's dropping that are more likely to do something.
Sure.
Most of the time when we do something, it's not good.
And Danielle, your overall take on risk. What's your involvement yourself as an investor with risk?
Yeah, risk is a really interesting concept. You framed it in terms of volatility. I think that sometimes is a bit of a narrow definition because volatility means that you get some awful shocks like we're seeing in reporting season at the moment. So lots of examples. WiseTech down 20% today, other stocks up 20% tomorrow. But that volatility doesn't become a risk to your portfolio unless you actually act on it. So you have to actually say, oh my gosh, I have to sell these shares because they're going down. You know, the whole narrative or story or the company that I believed in is going to hell, you know, handbasketed, and you throw it out with the baby in the bathwater. So the first thing is, from a technical perspective, it may be volatility, but for the average person, the you and the me in the street who invest our money, I guess it's more about having a definition of how you are trying to grow your wealth over time and acknowledging what your risk parameters are, so what you're comfortable with. And when I wrote the Shareholders books, I always came back to the fact that my own personal story, my childhood, when Mum lost all her money on the Poseidon, the stock from the 70s, some of you may remember it. And she was deeply traumatised, almost had a nervous breakdown over it. And as a young child, I was deeply impacted. So my whole life and career has been around creating financial security. So I've always been a huge saver, and arguably I'm too risk averse on some occasions. So once you can acknowledge which type of person you are, how you see risk, whether if you're a huge risk taker, then you have to be prepared to possibly be very diversified, because if you're going to go into private equity or venture capital, you just don't do one exposure, of which I managed to do and quietly, you know, wrote off £25,000, which was, you know, I could afford to at the time, but I wouldn't do it now. So I think it's very personal, and I think it depends on your journey of what you're trying to achieve, and that's why it's sometimes, I think, very challenging for people to get around risk, because my risk is different to your risk.
It is such a great point about how personal it is. I reflect on my father, who was just in town visiting for a couple of months. He just flew out this morning. He, for 37 years, was a commodities trader on the trading floor in Chicago. And you talk about risk, I mean, that is risky. And I saw that growing up. And his idea of a diversification was, well, I'm not going to be in corn futures. I'm going to branch out and buy some S&P 500 futures. You know? It's like, and that's why I just like blue chip stocks. I'm much more, I think, aligned with you, Danielle, on that. That is very interesting. So I guess to kind of, I don't know, try to draw up some kind of contemporary today examples, just want to go around the panel quickly. Like, what risks are keeping you awake at night, Rachel? What are you thinking about right now in terms of risk? What are you thinking about in terms of how you might change your allocation or your portfolio?
Okay, so I'll talk about our members first,
Please
and
do,
then myself second. What our members often talk about is diversification and not feeling that they are diversified enough. We also see that in the ASX investor study that came through, showing that a lot of investors, and I think there's 9 million investors in shares, don't feel that they're diversified enough, and women in particular. So, you know, thinking through, is my portfolio, is it how it should be? Is it got the right weightings? Members often comment around, maybe I've got too many bank stocks, mining stocks. So those are the things to really think about. The second point that ASA often talks about, which is similar to what Mark was saying, is avoid the noise. So we've got noise, we turn on the TV, we look at our phones as soon as we wake up. But that could actually, the behavioural side could make you make a decision that's not the best decision for you. So that's as far as our members. Myself, what keeps me awake? Well, I try not to look at my share portfolio too often. I mean, it's really easy to do that, but I have to remind myself of the time horizon. We've all got different personal investment plans and time horizons. And for me, I'm leaving a lot of things for the long run and taking advantage of compound interest. But that's not everyone's situation. Some people really need that income generation and need to be thinking about that. And when the market downturns, then that is a concern and people get worried. But you need to think about what's your financial plan. And if you don't have one written down, you can do it yourself, you can get advice. Put that down and think about, what are my goals? How am I tracking? What would be successful?
And just specifically on the point of your members, you mentioned kind of the split between miners and banks. Are we thinking, are they talking about overseas investment exposure
Yeah,
there?
that's the other point.
I realize
Actually,
it's the Australian shareholders, but you know.
Yeah, you're talking about like the 2%, exchange
Yeah.
of Australia versus having international shares. That's the reflection also often of our shareholders is, well, maybe I've got too much in the Australian shares. So thinking about how do you get access, how do you diversify, do you go into exchange-traded funds? Those are the things often our members are thinking about, but often with ETFs, if you've got 5 ETFs, you've really got to know what's in those 5 ETFs because they may be the same companies, and therefore you're not as diversified as you think you are. So I guess thinking about, what's the weighting of your portfolio? Do you have enough access to international shares? And really avoid the noise. It's hard, it's super hard to avoid the news in the morning, but you really need to think long-term. If long-term is your plan, some people do need their cash within 1 to 2 years because they've got plans of a fabulous holiday or something else that they want to do.
Yeah, you make that point about ETF concentration and overlap. I mean, right now, the stat escapes me, but the returns of the S&P 500 are coming from, 7, 8, 10 stocks in one of those ETFs? So, yeah, exactly. Mark, risks on your mind, either from a house view at Morningstar or you personally?
Yeah, I mean, I guess the first thing I wanted to say is that there are always hundreds of reasons not to invest. And I think one of the problems we get into and what we forget is that at any point in time, there are all these risks floating around, whether they're actually come to fruition or just something we're worried about. And I want to start off there. I also want to say that, one of the problems that investors have is the idea that you need to constantly adjust your portfolio to what's actually happening right now. And I think that's really dangerous because number one, a lot of people, of course, are wrong. And even if we talk about a risk that's happening right now, of course, everyone's hearing about China and the issues happening with China. Well, if you went and found an AFR from the beginning of this year, what did every portfolio manager tell you to do? Invest in China. Yeah. So I think we just have to be really careful about this need to constantly adjust our portfolio based on what's happening. And, I think right now the thing, and, this is obviously a larger risk, I guess the thing that I would be most worried about is the level of debt in the world. And, S&P put out this study at the end of 2022, just looking at really from the GFC and when interest rates originally went down, obviously all the way through COVID, how much debt has been taken out by countries, by companies, by individuals. And even if we sit here and we talk about some of the things happening in Australia, if we just look at mortgages, so if you go back to 1970, obviously a little while, mortgage debt in Australia was about 10% of GDP, and it's now 90%. And certainly we are hearing a lot, and it's 90%, and a third of all houses are actually fully paid off. So it's a lot of debt being held by a small amount of, or a relatively small amount of homeowners. So yeah, I mean, I think debt more than anything else, and obviously with interest rates going up, and I personally think that they are going to stay up for a while. I think that all of this interest rates are going back down to where they were is a little bit of a pipe dream and wishful thinking by people. So yeah, I think debt and things that start blowing up, and that's what we're seeing in China, right? Especially with a lot of the property developers and how much debt they have. Yeah.
And Danielle, what risk concerns are on your mind at the moment?
Yeah, it's an interesting question, isn't it? Debt's really interesting to focus on because debt around the world has gone up massively, and I know that we talk about our debt, so I think we've got some of the highest per capita debt because of mortgages here in Australia, but China is one of the most indebted countries in the world, but it's not an open economy. Yeah, debt has gone up hugely, but what does that debt do to economies? It actually slows down GDP growth. It acts as a depressant, okay? So the more debt you have, the more debt you need to grow an economy. So once upon a time, I can't remember the exact ratio, but you actually need to add more debt to get growth, particularly with ageing populations. Does that keep me awake at night? Definitely not. I had the privilege under my wonderful new job at AusBiz to speak to Bill Browder, who is quite famous for writing Red Notice, and a very interesting story, the Magnitsky Act, of which he was involved in. And why is this important? He was an emerging markets investor, one of the largest in the 1990s, and I used to work at a company called Bearings, which was a very large emerging markets fund until we blew up, so speak about risk. But nevertheless, my point is that we focused on geopolitical risk, and I agree with him. I think geopolitical risk has not only changed, but it is amplifying. You are seeing a dividing of the world. As we speak, we have the BRIC nations meeting down in South Africa, BRIC being Brazil, Russia, India, and China. And Putin can't go because he might be arrested, but hey-ho. But the point is the world having been so, I suppose, open to global trade, it grew post-World War II, if you're looking at long secular trends, that is being broken at the moment. So how do you invest around that? How do you invest around something like climate change, which is a massive systemic risk to every business, to every society out there? And I think it goes back to the fundamental thing, you don't want to stay awake at night, going on about these things, because it'll do your head in completely. But companies have survived over the longer term. They have survived through wars, they've survived through pandemics. And a very wise fund manager, again, through Ausbiz, who I've had the pleasure of speaking to, called Alan McFarlane, who's they're called the canny Scots because they're very astute fund managers. And he focused it right back on the thing. You want to own those great companies that can generate cash flow, that can produce dividends and have that resilience. And one way of mitigating the risk in your portfolio is investing in great companies that have the capacity to go through cycles. Now, the problem then becomes is that there's not a lot of them. And that's when it gets very challenging. And that's what Warren Buffett would say. And if you want to look into research, there's a gentleman called Professor Hendrik Bessembinder who does amazing research about how few companies actually produce the returns for investors. So what I'm saying is rather than being stressed about the events that you can't control, you look to what you can control. So for example, rather than investing in emerging markets directly, by the way, Bill Browder will never touch an emerging market with a dictator or anything again, too much sovereign risk. And you are seeing that play out. But you can buy a Unilever or a Coca-Cola or an Apple, by way of example, to give yourself exposure, global exposure. So I would say bring the risk on board of what you can control as opposed to what you can't control.
Yeah, and if we could just stay with that, Danielle, and we'll move on to the next question, which is, it sounds to me like you're describing economic moats in some way, shape, or form.
Yeah, well, the companies would have that characteristic of an economic moat.
Yep.
Clearly they would. But resilience is almost what you're looking for in companies. And I'll admit, I own a company called Eli Lilly, and I kind of tripped all over it, but you would have heard of it because they're very much involved in the diabetes drug that is now a weight loss drug that's getting FDA approval. Well, this company, it's up hugely. It's probably now a momentum trade, et cetera, et cetera. But it's back to its 1953 share price overnight. How, does that do your head in? Imagine if you'd bought it back in 1953, the roller coaster ride you would have had. But yet, there's a whole new crop of investors. So that is a company. Some companies show resilience that have moats, but they change over time.
That's a really good point. I've got young kids, and I'm investing on their behalf, and I think about it so differently than my own portfolio management decisions, and basically I just buy Apple shares for them. And that's a good example. Mark, any specific, be they indicators, ratios? I hate to get too technical, but anything you look at when you're assessing risk in your own portfolio, or what Morningstar kind of believes in when it comes to risk and how to kind of quantify it?
Yeah, I mean, you mentioned moats, and obviously it's something that Morningstar does talk about a lot, but we also have a rating called the uncertainty rating. And, I think obviously when you are investing, you are buying a company. And I think we all need to understand that different companies have different types of business risk, right? And that's not any sort of risk that has to do with the share market. It has to do with the risk of that actual company. And I think it's just getting comfortable. So, a very simplified example is that a large multinational company that's been around forever, that has multiple product lines, that has low debt, has a very different risk profile to a very small miner who is hopefully going to find something and hopefully not run out of money before they actually dig it out of the earth. And I think people lose sight of that we think every company is the same. And so Morningstar actually has something called the uncertainty rating, which looks at that business risk and and that business risk can be financial. If a company has more debt, it is riskier. And the example I always use is during COVID, Australia had 2 airlines. Well, one went out of business. Why is that? Neither of them were flying. Well, Virgin had a ton of debt. And so they obviously could not deal with the drop in revenue when nobody was flying. So I think it's just looking at all those different factors of a company and finding what you're comfortable in. And there is no right or wrong way to do that. So riskier companies have a wider range of outcomes. So one is that they can go bankrupt. One is, of course, they could turn into the next Apple. But personally, I'm much more comfortable investing in companies with lower business risk. Now, that's just a personal thing, and that's, I think maybe a lot of my experiences have sort of led me down that path. But I think it's investors knowing what's in your portfolio. And knowing what's in your portfolio is not just sort of surface level thinking, okay, I kind of understand what this company does. I understand what they sell. It's really understanding the risks around that company, what's the competitive environment in that industry. And so I think that that's really the way that I like to look at my portfolio and look at it, those individual companies.
Okay. Yeah. And Rachel, any sort of key metrics you look at when it comes to assessing risk?
Yeah, I'd be just looking at percentages. I'd be getting back to the spreadsheet. I know initially you were saying, our spreadsheets are outdated. I think there's great software, but there's also great spreadsheets. So looking at that percentage weighting and back to that mining or banking or whatever it might be, really look at your sectors and look at your asset classes, because each asset class is going to have a different risk tolerance as well.
Indeed, yeah. And on that, I'll remain here with you. Asset allocation, diversification, it sounds like what I'm hearing from the panel, it sounds like you're an advocate of broad diversification, is that correct?
I would say yes, but I'm actually listening to my fellow panelists. I think the point is you need to be investing in those good companies, but you need to understand the sectors, you need to understand the company. A lot of our members, they do love reading the annual report, turning up, asking questions through earnings season. So, if you can't be diversified as much as your financial planner or a tool might say, ask yourself the question, do I understand what I'm invested in? If you don't understand what you're invested in, then you can either do 2 things, learn more, or decide that that's not the right company for you. So you do need to find those great companies with great leadership teams. But yeah, you need to be across it.
Yeah. And Mark, I know Morningstar does a lot of thought leadership stuff in asset allocation and, the acquisition of Ibbotson 15, 20 years ago. But you sound like you're more of a stock picker yourself. Is that accurate?
That's what I'm talking about more, but I do invest in ETFs as well, and we do have ETF research. But I think kind of the diversification question is interesting because I think a lot of people perhaps use the word a lot and don't actually think about what it means.
Yeah.
And if we think about diversification, I think a lot of people think it's sort of like having a market neutral portfolio, that one asset goes up and one asset goes down. And that's not really diversification. Diversification, if we think about it, we're trying to diversify away single security risk, right? We're trying to diversify away the fact that management at a company we own could make a really dumb decision, and that dumb decision could lead to the company going down. They could be crooks, right? We have all sorts of, Enron was one of the biggest companies in the US. Well, they were cooking the books, right? We're diversifying away that single security risk. And that's how I look at diversification. So, if my whole portfolio goes down at the same time, well, I guess that's fine. That's not the risk I guess I'm trying to take away. Yeah, that happens often. But Yeah, when I think about diversification, it's that, yeah, one of these companies, no matter how much I study it, how much I think I know, it could blow up for all sorts of different reasons. So that's the way I guess I look at diversification.
Yeah. Danielle, any comments on diversification, indexation versus stock selection?
Yeah, in my books I describe you can have an ETF as a backbone and you can have the ribs as the stocks. Interesting, again, Mark, when you talk about one of those massive, a drawdown event, which I think is really important for people to understand, because we've had a few major drawdown events which often don't have anything to do with stocks but have to do with major credit events or liquidity events in the system where you have systemic risk, which sets off a whole lot of other things going on. So at the beginning of the year, we had the concerns over the US banks, what was happening there. And of course, because we have very highly levered financial systems, what happens is if one institution goes under, the tentacles can spread out across all financial assets. So it's really important to understand that when we get those drawdown events, that they provide really good buying opportunities. But if you are trying to diversify away from a liquidity event like that, you have to have non-correlated assets. So non-correlated assets would be things like alternatives, hedge funds, or let's say investing in agri-funds or something of that nature. Because typically you will get different performances out of shares at a point in time, but remember that we are still vulnerable, quote unquote, to those drawdown events, which is a lot more technical, a lot more complex, and something that the Fed has been working really hard in this cycle not to let that happen as interest rates have risen. So when you think about diversification, you have diversification within your share portfolio, you have diversification between, let's say, your home that you own versus your share portfolio versus the cash on hand that you have. And so there's so many different ways to cut the diversification portfolio. That's how I look at it. But when it comes to shares, I think sometimes when you do look too closely, too often, and you can get drawn into that sort of the trend is your friend or the momentum or whatever, and that can drag you down into the biotechs, into the oil and gas explorers. No offense to anybody that loves to invest in those. It's not my cup of tea because inevitably I just, blow up money. But you just have to realize that, it's important sometimes not to over-diversify. Sometimes we can over-diversify, and then you should have maybe just gone and bought the ASX 300 ETF by way of example and cut down on a whole lot of fees. So again, it always comes down to knowing yourself, knowing how much work you're going to put into it, what your comfort level is.
Yeah. There's a lot of, people get mixed up because there's a lot of advertising out there around asset allocation, diversification, and all that. I remember there's a line from the great show The Sopranos where Tony and Carmela are arguing over family finances. He's like, I got my money tied up in asset allocation. And as a nerdy finance guy, I was like, God, that doesn't make any sense. But that's what people think, So on what strikes me as a very important point, though, when it does come to, shall we say, academic asset allocation, though, is drawdown, meaning in retirement. So as we move as a society from this accumulation phase, largely because of the boomers and kind of nearing the retirement age, and then all of these kind of growth assets ought to be arguably turning into defensive and yield-producing assets. That's quite interesting. And I guess, I don't know, I just wanted to kind of tease out some thoughts on risk in retirement. I don't know if you have any thoughts on that, Rachel. It's a big topic, but I feel like we're wholly unprepared as a society, at least from the stuff that I consume. And that may be an echo chamber of my own, but I find it fascinating as people live longer, especially.
Yeah, I think there's one thing there is we don't know how long we're going to live for. So you have your goal of how much you need, and we live longer than we expect in general. Also find that in retirement, people aren't spending all of their money. So there's quite a bit sitting there often. Not everyone's in that situation, but there is that when you look at it overall. The other thing from a risk perspective is it's making sure you've got the income generation you need when you're retired. And thinking about your family too, because another risk is do you have your estate planning in place? what will happen to those funds? So you need enough to live on, you need enough for your goals, and there's a lot of really great calculators out there about how much you need in retirement, or you may know that from your own experience, because you do want to have that holiday every year or every 2 years. So making sure you've got enough there. It all comes down again to your financial plan. So when you've got a financial plan in place, you think through all of those things of what I'm going to invest in, how much will I need in retirement. But on general, a lot of people don't spend the money that they have there, and really just protect your assets, because that's risk. So think about your assets, think about your family and what that means. And I'll just do a tiny plug. We do have an estate planning course, $55 on our website, and it is part of a package if anyone becomes a member.
Yeah, fantastic. Mark, what about from Morningstar's point of view? I mean, again, you guys do a lot of work on asset allocation. Does that happen on the other side of the mountain as well, so to speak? And kind of what are you guys seeing from the retirement planning side of things?
Yeah. And then, I mean, I think I could obviously spend a while talking about this. We have, and Christine Benz, who is a member of our research team in the US, who writes a lot, introduced this bucket portfolio method, looking at asset allocation going to retirement. I will say that's something I've used for my mother, and so far so good. And really it looks at, okay, what are the kind of twin risks that you face? And we talked a little bit about them, so it's obviously sequencing risk, so the worry that the order of returns actually matters. It's retiring into a bear market, retiring into a situation where your portfolio is not doing well, so that's where volatility does really impact you. And then, of course, it's longevity risk, and Rachel, you mentioned it, that, of course, none of us know how long we're going to live. And it makes it very hard to plan anything when you don't know the end date. So yeah, I think that that's really what Christine is trying to tackle with this bucket portfolio, and making sure that hopefully you have a way to not sell down assets when you don't want to, and that's when they've gone down. But I think from a society standpoint, what's the biggest risk is for most people is that they're not going to save enough. And I think a lot of that comes from people don't think about retirement at all. And that's probably the biggest problem, I think, overall from a society perspective that we have with retirement, that nobody bothers to spend any time even estimating what they'll need, and then they don't save enough. Assume that the mandated contributions into super are enough, for example, and it just becomes very hard to catch up as you're approaching retirement.
Danielle, you mentioned you were perhaps a bit more conservative as an investor. And so do you have that in mind then, kind of that capital preservation and then what you can do with it on the downside in retirement? Is that sort of built into your initial evaluation process?
Yeah, it's slightly impacted by the fact that I had to kind of quit working while I raised my son. So that's why I was very defensive of my savings that I've built up. Now that I, thankfully, for now, have a career again, which is very exciting, my risk profile might change a little bit. I'm going to say something really controversial. I think retirement is a risk. I have met really an amazing 90-year-old that you all probably have heard of, Noel Whittaker, last week when I did a presentation, we were in conversation. And it's so amazing. He's writing a book on retirement, but he is so not near retirement. He is the most active man. And it reminded me of Charlie Munger and Warren Buffett. And I don't know, if we are going to all live longer, we all maybe need to question what do we do with our lives? Because there's only, in my humble opinion, so many cups of coffees, lunches and everything you can do. So just going a little bit left field, you look at these guys in these 90s that are living their real lives. I mean, they're amazing, but they're so engaged, and they would never even think about retiring. Having said that, not everybody is in that position. Ideally, if you can set up a portfolio where it can generate the income without touching the capital, that is obviously the most optimal situation. So if you get into an event, a black swan event, and you need to access the capital, then it's there. But not everybody necessarily has that ability.
Yeah, and you can see that. I mean, personally, again, my dad's retired. it's just like his world kind of gets smaller and smaller and smaller. And then my mom has gone back to work as a nurse, and she's just like
Happy
a pistol.
as.
Absolutely, yeah.
Yeah.
And the difference is it's totally flipped from kind of
Yeah.
how it used to be. That's a really, really interesting point.
You're not just upset that he spent 2 months with you in Australia, and that's what
I was
the
saying to
time
Mark,
done.
it was a weird day for me. I drove them to the airport this morning after 2 months being here. I was sad, but I was like, all right, let's get on. I got to get back to work. So, yeah. I want to talk about mistakes. Rachel, what are the most common mistakes investors make when it comes to, well, misevaluating risk or even making poor investment decisions? What do you see from your members or,
Well, I've talked about the different sectors. So something different and behavioural is getting too excited, I guess. We all can get very excited about a specific company, and the example of, again, nothing against miners, but, go to an event and it's all about we're about to dig a hole and we've got some good news coming. So you don't want to have too many of those in your portfolio. So just being aware that you are investing in those good companies and what life stage are you at, what kind of income generation do you need, and franking credits, all those kinds of things you do need to think about. So don't get too excited. Really think about the companies or the investment strategy that you have in place. And if you don't have one, then it's time to put something simple in place. And then the other one is reviewing your portfolio regularly, because a lot of our members, like many shareholders, they hold for long periods of time, 10 plus years. You ask yourself the question, how often do I look at my portfolio? Should I be looking at it, 4 times a year, twice a year, once a year? Whatever works for you, whatever works with your personal investment plan. It's good to leave well-performing companies, but are you confident that you do have well-performing companies there? And then the other one around psychology is we often have one share, could be multiple shares, it's just not performing well. And you're waiting for that one day, it's going to come back to the amount you spent. You do not want to lose any money. Well, think about that. So are you already losing significant sums that if you put in something else that you would actually have a good return? So I think that's the other one. I've got one, I keep thinking about it all the time, and I'll probably make that decision soon. So just have a look at that and think, do I need to get rid of it? Is there a better investment where that money could be? Do I take the loss?
You don't want to name and shame what that company is, do you?
No. I mean, it's performed well, but I don't know how well it's going to keep performing. That's the question, and that's, you're thinking about all of those things around cash.
My own personal one is, and you were saying it, and I was just feeling my chest constricting, is Alibaba, which I've kind of now broken even on, but man, it's been a wild ride, and I'm holding on for dear life and in the face of some serious geopolitical problems.
I totally understand. It was a biotech at one point that I had, and when I went to one of our member meetings, I came away and I went, that's it. I am going to do exactly what we talk about, and I am getting rid of that because I don't think it's going to perform.
That's very good. Common mistakes, Mark, when it comes to risk or...
Yeah, I won't talk about my own since we don't have hours up here, but I think the biggest thing, and I agree with everything that Rachel said, by the way, but obviously I don't want to repeat all of it, but I think the biggest thing is just inertia. That, at the end of the day, and, I guess using a behavioral term, we'll call it recency bias, we all kind of expect the same thing to keep happening. And, I mentioned a little bit on that discussion around debt and rates. And, I think we have to understand, and as Danielle was explaining, the world seems to be going through this structural shift, right? Where we're pulling back from globalization. We are obviously kind of moving into this sort of, multipolar world again, when it seemed like we were all coming together for a while. So there's a lot of things happening, and a lot of them, and I won't go through all of it, but a lot of them really are saying that this period that we went through where interest rates were low and inflation was low potentially is gone. And I think just right now, and that was my comment about interest rates staying higher, I think right now we all need to start accepting that potentially. And there's so many people, and I hear from so many people that, at the end of the day, and I know how fast, and I know it was a historically fast tightening regime by the RBA and by other central banks, but the catch rate's 4.1%. And the way that people talk about it, you would think it was 20%. Yeah. And I think that we have to understand that over the long term, that is much more indicative of what rates are, and that they may bounce a little lower, may bounce a little higher. But I think we just have to understand that, potentially the stuff that's been working isn't going to work anymore, and adjust to this new world that it seems like we're going into. And whether that pans out or not, I think a lot of people, it's just that inertia of just expecting the same thing to happen over and over and over again, and that can put people in danger.
And it's a good point about rates. I mean, talking with the Sharesight product team the other night, I reminded them and myself, frankly, that we've built Sharesight and grown the business in a bull market. That's it. It was always up and to the right. Every time I give a product demo, I would just whack a demo portfolio in there, and it just went up and to the right. It looked good on the screen. Now they don't. So I have to reconstruct a portfolio that looks kind of more realistic to what's actually happened. But I said to the guys, this is why multi-asset is so important for us, because people are getting a yield on things, and we can't just be Sharesight. We have to be whatever, multi-asset site, essentially. So I think that's a very good point about rates specifically. Danielle, mistakes. Common investing mistakes.
Yes, mistakes. I've made a few.
Behavioral mistakes.
Or more. Interesting question for the audience. Any golfers out there? Any hands up? Little, maybe? Okay. Golf's a really good example of investing, because investing some of us, we try and go for perfect. And if you play golf, you'll quickly learn that perfect just doesn't exist. It's a game of calculated risks. And when I first went to London and I joined an institutional broker, the name was Macintosh, you might remember it, Macintosh Hampson Horgavet, and I was replacing a lady, and the first thing she said to me was, Danny, don't expect to get more than 50% of your recommendations correct. I went, oh my God, well, how am I going to justify my existence to these fund managers? Because I'm meant to be telling them. Anyway, the point is, you're not going to get it right all the time. There is no silver bullet to investing. When we try and do things to outperform the index or to be perfect, that's when all the mistakes I find come flying out. So the first thing I always remind myself, I'm not investing against the ASX 200 or the S&P 500. I am trying to stay the course of investing in those companies that, even if they're not the Apple, they're going to be close to the Apple, they're going to be around, they're going to give me a dividend, etc. And it's that little narrative that pops into the head about the latest secular trend, and you sort of start salivating, going, that ETF looks nice. And then you go, no, they're possibly, no offense to ETF providers, coming to the market because you're at the top of that ETF cycle, by way of example. So one other little thing to take with you, and I was reading Professor Damodaran, he's the professor of finding value at New York University. He has the 3 Ps. You have possible, plausible, and probable. And mining companies, everything's possible. Is it plausible? Maybe. Is it probable? Well, not always. They usually try and flog the asset off to some poor, unsuspecting other person. So he advocates you look at finding investments that you tick the 3 Ps with.
Fantastic. That's fantastic. All right, we'll do one more question, then we'll turn it over to the audience for some Q&A. So Rachel, ASA, what do you guys produce? What can you do? What advocacy can you guys provide when it comes to assessing risk in investments?
Okay, so we do 2 main things. One is education. So that education is through, the magazine, the conferences, webinars. So we do education. We also do company monitoring. So we have a lot of volunteers. We have about 200 volunteers that monitor ASX companies every year. They go and speak to the chairs. They ask the tough questions. They stand up in AGMs. And so then they provide those reports back to all ASA's members so they can decide how they want to vote at upcoming AGMs. And that's the thing, a lot of us don't get around to voting for AGMs, but we really need to as investors. We really need to be engaged to give our proxy. You can give your proxy to the ASA whether you're a member or not. So lots of things that we have, but we're a not-for-profit. We've been around 60 years, and we're here to support and stand up for retail shareholders on advocacy, monitoring companies, and providing education.
Mark Morningstar, you mentioned uncertainty ratings. Anything else that you guys produce around risk?
Yeah, I think as I said before, one of the in my mind, one of the most important things is obviously understanding the investments and understanding the businesses if you're buying shares, understanding what's in a ETF or a fund, if it's passive, if it's active, understanding the approach that a manager is actually taking to decide what goes in there. So, what I always say about our research reports, so we have teams of analysts cover equities and also cover funds and ETFs. What I always say is, people focus a lot on the ratings. Is a 4-star stock? Is it a 5-star stock? But just read the reports. And, I think more than anything, it's just understanding whether our analyst is right or wrong, understanding what's actually that investment means. And I do think that while they sometimes write like an analyst, and it's a little difficult to understand, I think what they really do is they really spend a lot of time, and if you speak to our analysts, that obviously I'm lucky enough to do, speak to our analysts, they really understand the companies and they really understand the products, and use that as an input into your own investment process. Because anybody, any analyst, any fund manager you read about in the newspaper or you see on ausbiz, they can provide insights that should go into your own process, because we're all different. We're all trying to accomplish different things. We're all comfortable with different types of investments. So just go out there and use those inputs. And I do think that our research reports are a good way to learn about the company. And what's important is not necessarily them telling you what to do, but them educating you on companies, on different investment products.
Yeah, what I discovered, I own a company called Ball Jar. They make jars, basically, in Colorado.
Appropriately named.
Yeah, that's right. But I learned from reading the Morningstar research that actually, because of their manufacturing process, they're like the leading provider of aluminium to NASA, because they've developed this way of making lids and things for jars at scale that are really high quality. And that's just the nerdy stuff you learn from reading those reports, basically. So.
And I might say that maybe it's the combination, because you look at a Morningstar analyst report, you can also look at Australian Shareholders Association, a voting intention put together by another retail shareholder. They're all sources of information that you take into making your own decisions.
Yeah, form a triangulated view, as it were. Danielle, any resources from ausbiz or your...
ausbiz has lots. We have lots of fabulous interviews.
Or your book, of course.
with companies, with fund managers. We also have the flagship program, The Call, where you can put in your requests for our expert guests to talk about a stock. We also interview people into other geographic locations, into the US, to get an idea of what's going on there, as well as Asia and the UK. And basically, it's the only dedicated business channel, live streaming channel, so you can watch it live on the app or on, sorry, this mic keeps moving, or on your computer, and I think it's on 7 Plus as well, but Kylie is at the back and Carolina, and they can confirm that. And the other thing that you can do is watch video on demand. So it's, a great platform from 9:30 to 4:30 to get a rundown from all the experts, what they're saying, what they're doing. And if you subscribe to the newsletter, you get to read me and my thoughts.
And you also get to watch Shani every month.
Absolutely, the beautiful Shani.
Yeah, that was a terrific discussion. We'll turn it over to the audience, but I'm happy we didn't get too technical. We didn't talk about sigmas and sortinos and things like that, but I'd be remiss if I didn't just remind ourselves that we're currently sitting in the beta function space, and downstairs is alpha, which is not planned, but strangely appropriate.
But where's gamma?
Gamma's upstairs. Okay, so with that, let's turn it over to the audience. If you've got questions for the panelists, or I suppose for myself as well, happy to take those on.
Is this directed at me as the American?
I'm hiding behind the veil of the moderator.
Oh, God, that's a tough one. I'm just very much not looking forward to it in general. But listen, it's very hard, obviously, to predict what's going to happen. I think certainly Trump has historically had very destabilizing impacts on one, I think, kind of geopolitical stance of the U.S. If we look at a lot of the unity around NATO right now and supporting Ukraine in the war, I think a lot of people are very nervous that that's not going to continue with Trump. A lot of the protectionism, particularly with China, has kind of continued. Obviously, the rhetoric turned down a little bit. But yeah, I'd say at the end of the day, it's probably going to be fairly messy. There's a lot of things that are happening right now that are certainly adding volatility to the markets. And regardless of who gets elected, I think sort of the run up to the election, which in the US obviously takes a very, very long time, probably isn't going to do anything to dampen any of that volatility. So I guess I would say that's probably what I would think that the biggest impact would be. I don't know.
Danielle, do you have any thoughts on that one?
This microphone. It's a tough one, isn't it? I was surprised with the reaction when he got in last time. The market sold off heavily and then rallied, and Carl Icahn had been in buying furiously, realising that all these tax cuts and all these really company-friendly policies would be introduced by Trump, but obviously his agenda has changed massively. I guess we could turn it on its head and say, if it becomes like the US becomes quote-unquote a failed state or something of that nature, where on earth because US treasuries and US dollars are basically the world's collateral, and there is nowhere else in the world where that collateral can actually go. Like, if anyone wants to, get down into the weeds, there's a guy called Michael Howell from Cross Border Capital who does the best work on this in the globe, and I did work with him at Barings, and he's very free with his time. There's lots of YouTubes and things, so I have no idea. I'm dreading it as well, but all I would say is that the US treasuries are the globe's collateral for all the loans that are out there. So it begs the question, if you get a total meltdown for some geopolitical event, what happens? But you looked at the insurrection, markets didn't even move. It's quite bizarre. So maybe sectors will move. I have no idea, but sometimes I'm surprised, and I don't know what you think, Mark, or any of the panel. Sometimes it takes a really massive geopolitical event to shift investors and to a risk off.
Any thoughts?
I'll probably not get into the politics of it, but I think that's a really good point around sometimes there's a lot of talk or there's fluctuation in a day or a few hours or a half day that doesn't have a long-term impact. So it's really, really hard sometimes to have the crystal ball and what that means.
Yeah.
But I'll leave the American politics alone.
The reserve currency, I think, is a very interesting point, and I would agree with that. And I think it was Ray Dalio who said, that is the tipping point. If that is questioned,
it can't change. There's nowhere for it to go. I mean, there's lots of hype and everything. But seriously, are you guys all going to race off and put your money into, this new brick currency apparently that's backed by gold, or are you going to put all your money in Bitcoin? And that's the thing. It's when push comes to shove, the US government is not going to default on its debt. Whereas Russia did in 1998 and sent long-term capital management down.
Indeed. Next question. Yes, gentleman in the back. Yeah, in the middle. Yes. Chinese real estate. Any takers on that one?
I don't think you need to worry about global contagion. Again, if you want to dive into the weeds more on that stuff, Victor Shvets, who you can follow on LinkedIn, who's the Macquarie strategist. He's a fabulously eccentric Ukrainian, again, who I had the pleasure of working with, who's written a big book on this called The Global Rupture. And I think that it's whilst there might be a couple of ructions, because I think BlackRock holds some of Evergrande's US dollar denominated bonds, but nothing appears at this stage to be systemic, and everything is basically within the closed Chinese economy. So, he's written a piece this week on LinkedIn specifically about Chinese property. So if you're on LinkedIn, you just follow Victor and you can read the posts.
Mark or Rachel, any
it's
comments?
above my pay scale.
Yeah, I think the only thing that I would say about China, if we look at China on a wider basis, we need to remember, and I made that comment about the AFR and all the portfolio managers telling us to invest in China, now is a great time. But if we go back and look at the narrative, it's that as China got out of sort of the COVID lockdowns, that was supposed to be the engine that was going to drive the world economy, that Chinese growth would return. I don't think anyone's thinking that now. And, and we go back even further. There was a point in time where people said that China would keep growing at 10% a year, GDP. Well, now they're at 5. And so 4. Okay. So yeah, I mean, I think that the narrative about China is sort of this growth story that we all became so enamored on is seemingly going away. And I think the question is, how does that impact everyone else? Not necessarily a blow up taking down the world, but just sort of that slower growth. And especially, obviously, if we look in Australia and look at some of the resource sectors, what does slower growth mean? Well, it's not going to be a blow up necessarily, but it's going to be, once again, a future that looks different than the past.
Yeah, and I'd only just comment on like Australian companies and the potential impact, and a lot of them that could be impacted are commenting through the earnings season there.
I have something on that. It's really interesting because I interviewed Will Hamilton of Hamilton Wealth down in America, and he goes to a big investment management conference in Monaco every year, and they were talking just about this, about how to let retail investors get a slice of the private markets, which have outperformed. When you come from an institutional background like mine, that is like the biggest red warning flag. It's like, because the retail market wants a slice of that pie, the institutional market goes, fabulous, we'll design the product for you and give it to you. And the problem with that is the weight of money from the retail market will drive the generation of the products, which means you have to be very circumspect about what you're buying into, because the institutional market by design wants to make money. There's quite a few cynics around, why mutual funds were designed, why ETFs have been so successful, because for the business it becomes an annuity stream of income, ours, drip feeding into them. So the only thing I'd say, when you start diversifying into non-correlated assets, be it agri, be it hedge funds, supposedly, and they do go under, don't underestimate, long-term capital management, that was never meant to go under. That one in, 500-year risk event, oops, Russia just defaulted, oh dear, we've got a systemic risk. So all I would say is, always put it in the context. You always hear the good stories. You always hear about someone that invested in Canva before they listed, or at Atlassian before they listed, or, why didn't I buy Apple at $12? Coulda, shoulda, woulda, big shame. But be really circumspect when these products come to the retail market, because they're not doing it for you. You are taking the risk. The fund manager gets you to sign away and say, historical performance is no prediction of future. Well, we're going to do our best to outperform whatever benchmark they give you, but you're taking the risk. So that's someone that comes from institutional who's quite cynical about it, and that's why, as much as I sometimes listen to these alternatives, I just sometimes go, I'm just going to stick to my cash, my little house, and shares, because it's a gain for me, who's sometimes possibly a nervous Nelly, a control thing. But if you do want to put your money in, it goes back to, how do I asset allocate across that thing? I have to put in enough to make a difference to my performance over the longer term, but if it does go completely pear-shaped, am I comfortable with the loss? It's as simple as that. That's how I see it.
There's a saying that goes, financial products are sold, not bought.
Correct.
So
yeah, they're not doing it because they like you. Sorry, you have to be cynical though.
Any comments, Rachel, Mark, on that one?
I would just say, like, some of them that I have seen, and again, it's a personal decision, is, the high amounts that you need to put in, and also, sometimes things sound too good to be true. So I might be a bit too conservative as well. I've heard some different things around this amount, you'll get this percentage. and it's just not for me. But if you're going to go that way, again, it's all about research. Do your own research. Make sure you feel comfortable and it's aligned with your risk tolerances, because we're all different and we've all got different strategies.
Yeah, I mean, the only thing I would add is, personally, I wouldn't touch that because the fees are too high. And ultimately, and it's the only thing I would add, I agree with everything you said. Why are they introducing this stuff? Because the fees are higher. And so I just don't buy it. And like, if you look at any returns of any products, fees have a huge influence on those. So if they want to start lowering the fees to what you would pay for an index fund, then that's great. And the other side is, I don't necessarily, and there's been a lot of talk about it this year with some of the super funds, but I don't necessarily buy the returns either. Like, it just doesn't fundamentally make any sense to me that private equity, and I'll tell you the reason I think it's this way, but that private equity has such high returns at this point when there's so much money in it, right? This isn't like the beginning of private equity when there are a couple people doing it. There's so much money in private equity, and they keep telling us the returns are higher, but why are they fundamentally higher than public companies? They're all operating in the same economy. They're all selling the same products, and I think it's because of debt. So they've loaded up on a ton of debt, and as we talked about how environments change, how are they going to do in this world when it costs more to go out and get debt? And so that's one concern. And then, of course, yeah, we've read about these super funds, and we look at, retail real estate investment trusts, and then we look at what some of these super funds are holding unlisted property at. The valuations are stickier, right? So at the end of the day, they tell us how it's lower volatility and it's uncorrelated.
They just don't revalue them.
Yeah, they just don't change the valuation. So it's like, if I don't look at my brokerage account when the market's fallen, in my head I'm like, oh, well, it's still worth this much. Like that's not necessarily the value of those assets. So I guess I just have some concerns around that. And kind of the last thing is that uncorrelated nature of it. For me, and for some investors it could be very different. For me, I'm not really worried about correlation between different assets in my portfolio. I still have a while to go before retirement. I don't really care at this point. If the world blows up and everything's going down and something goes up a little bit, well, that doesn't really do anything. What I'm trying to do is look past that and figuring out where are we going to be in 20 years. And that's my view, by the way, and not Morningstar's, just in case anyone is taking that as a Morningstar view.
Further questions?
Oh, I don't really use technical analysis, but if it picked Apple at $12, go your hardest. We know that in hindsight, but I don't know how a chart when it was $12 would have told you it would have gone up thousands of %. I mean, technical analysis is good till it isn't good because it's very short term. Yes, I know there's the Krondorf, or however you pronounce it, long wave theories, but I think that it's a tool if you appreciate it with its limitations, what it can do for you versus what it can't do for you. It's always about knowing the limitations of the tools that you are using and working within those parameters. Because I go back to, there is no silver bullet, you're not going to get everything right. And are you holding a company like CSL, which is a great long-term performer, because you think that they will get it right over the next 20 years, or do you think because they've had a change of management and the pandemic has irrevocably changed the business? So it goes back to the boundaries of how you invest. If technical analysis works for you, that's great. But just appreciate, like every other bit of analysis, in my humble opinion, it's not a recommendation, everything has limitations. There's a great, Martin Kemp has written another book, one of his first books, Uncommon Sense. He got to finally go to the big Berkshire Hathaway meeting where thousands of people queue up, and then he did the course all about how to invest like Warren Buffett, and he's asking the questions, how do I do this, how do I do this, like what does Warren do that's so different? And they all say he reads, and he speaks to management, but he reads all day long. That's his success. So I think investing is very personal. Everybody has a different thing. If it was reading tea leaves that works for you, that's absolutely fine. But clearly companies like Morningstar, like ausbiz, like the Australian Shareholders Association, they don't necessarily, ausbiz has technical analysts, so you can definitely listen, but it's all very varied. Not all analysts are wrong, and not all technicians are wrong, but none of us are right 100% of the time.
That's well said. Anything to add to that, Rachel or Mark?
I thought that was pretty perfect.
Yeah.
You did really well.
It reminds me a little bit, I mean, I agree, it should be a tool in the toolkit, not the end-all be-all. The parallel that came to my mind was analytics in sport. And analytics, I'm a baseball fan, analytics has ruined
golf.
baseball. And golf too.
That
with-
golf swing, keeping
Absolutely.
it on plane.
Yeah, and you can see these decisions that are made by sporting clubs, professional or otherwise, that are purely analytic driven. They make no sense. It's just like, have you been watching the game in front of you? That guy sucks, or that guy's hurt. And I worry about that overtaking the, shall we say, the Warren Buffett element, where it's like common sense, just common sense, in addition to technical, which can work very well for some people.
But
Absolutely.
you forgot the thing about common sense. It's not very common.
No, it's not. No, it's not.
I would just say when we're looking at companies, we're asking them questions around risk, and climate change is a risk. So we do want to know what they're doing. Also, all companies need to address it. There's mandatory reporting coming out, so it's not long till there's that mandatory reporting, which is two things. It will be able to identify the risks and report on it, but also ensure that there's no greenwashing. So looking at the flip side, so really clear targets and KPIs there. Yeah, so all companies, I think companies are actually quite advanced in what they're doing at the moment around the climate change and the risks. And maybe the difference sometimes as a retail shareholder is we don't know that, see it, or sometimes we have conversations with investors around return on money versus ESG. You want both. You want a company that's doing the right things, that's going to be sustainable, financially sustainable, and sustainable in the long run. But I think that all companies need to think about what their risks are, and it's coming anyway. So whatever we personally believe, companies do need to report on it very soon.
Comments from Mark or Danielle?
I think it's a really interesting question because not only in Australia but globally, costs of just existence are going up so dramatically because of extreme weather events, and the amount of extreme weather events is going up as well. I disagree with Rachel about Australian companies being prepared. I think they've got a lot of blinkers on in the boardroom. Some are probably a little bit more on top of it.
And it might be size of company too, potentially.
No, I don't know. I just think it's really hard for everyone to get your head around. I've had thought about it long and hard and spoken to other people. It's like it's such a big existential risk that I think everybody sometimes just wants to close your eyes to it. In terms of how you manage a portfolio, I think the insurance companies are a really good example. Like, everybody loves them at the moment because they've been putting up their premiums. I've written about it. I wouldn't buy an insurance company, no way, because the reinsurance risk, Munich Reinsurance, all the big ones, they've been calling out climate change for years. Yes, I've been down the rabbit hole for many years on this one now, and costs of everything are going to go up, which also I have still been looking for. So if anybody knows anybody that can come and talk to me on ausbiz, I have been looking for someone to come and talk about, like, for example, with these risk events, if food prices go up because of climate change, our traditional tools of how we deal with the inflationary impact just go splat. Because, we say we put up interest rates because inflation is going up, but yet it's a massive driver from behind. So I think there's a lot of unknown questions. How you manage it in portfolio, look at the stocks and say which ones are potentially very, very vulnerable, To me, insurance companies are just a standout. Short term, premiums going up. Longer term, they're not insuring whole chunks of areas. Insurers have left California, they're leaving Florida. I'm talking, home insurance, etc.
Anything to add, Mark?
Yeah, I mean, I think the only thing I'd say is I do think it's a really good point, and there's so much controversy right now, and particularly in the U.S., but also in Australia around ESG, and Rachel and I were actually speaking before we came up here, and if we publish an article on our website on ESG, no one reads it. So it's sort of the instant way that we know we're not going to get many hits that day.
And if they do, they fight in the comments.
Well, yeah, exactly. But there's so much controversy over ESG, but as investors, we've spent this whole panel, for example, talking about risk. It's a risk. So ESG does not mean that this is some hippie that's telling you you can't drink out of a plastic straw. It is looking at a holistic set of risks that impact a company. And climate change will impact companies. They will have to spend a lot of money. That's not good for us as shareholders. And it's going to change the way that companies operate. And so we have to take that as a risk. And we have to consider how that impacts different companies. And so I think it's just become this political discussion, and the political discussion really has nothing to do with investing. So you can have all sorts of views on what we should be doing as a society about climate change, but as an investor, you have to figure out, will this impact the company that I'm investing in or not? And I mean, I think that's just something that we have to consider as investors.
Yeah. And the ESG stuff too, I spent some time reading about it. I did a presentation internally on it. I mean, you go down that rabbit hole and it's a classic case of well-intentioned, yet you implement a policy and then it has these unintended consequences over here. It's a bit like whack-a-mole in a sense, but we are out of time, I'm sorry, for questions from the audience. We need to take a 15-minute break and then reconvene at 4:35. Please join me in thanking our panelists, Danielle, Mark, and Rachel.